The subject of discussion with Sami Zeidan of Al Jazeera was a decade after Lehman. With that inspiration, I wrote a piece about a decade after Lehman this weekend. My career in the financial markets was in what is called the repo market, which was described thus in a Bloomberg article. Over here are investors with cash that's not doing anything profitable at the moment. Over there are banks with tons of bonds and a need for ready money. The so-called repo market is where the two sides meet. Repurchase agreements make up an essential, if esoteric, piece of financial plumbing. By providing a place where assets can be pawned for short-term loans, a healthy repo market helps a wide range of other transactions go more smoothly. But a repo meltdown was a crucial part of the financial panic in September 2008. I started my career financing Credit Suisse First Boston's balance sheet, and basically in those more swashbuckling days you could pirouette leverage of $200 to $1 of equity. I then ran a customer financing desk where we would finance hedge funds and all sorts. We expanded the business to include all the G7 markets and even emerging markets. All through the second half of the 1990s and onwards, one of the most profitable trades was at quarter end with Lehman Brothers. Lehman were renowned for playing the leverage game at 300 and 400 to 1, but at quarter end would need to show a much reduced leverage ratio, and we would enter into repo transactions with them, which were characterized as index-linked swaps. Subsequently, and much later, these were called Repo 105s. Repo 105 is Lehman Brothers' name for an accounting maneuver that it used where a short-term repurchase agreement is classified as a sale. The cash obtained through this sale is then used to pay down debt, allowing the company to appear to reduce its leverage by temporarily paying down liabilities just long enough to reflect on the company's published balance sheet. After the company's financial reports are published, the company borrows cash and repurchases its original assets. I also recall a time when I was asked to interview with Lehman in New York, and after a full day of interviews, I finally got to Dick Fult's office. And he turned to me and he asked, "Ali Khan, how much do you earn? How much are you worth?" I said a number, and he turned and said to me, "This room right here is where we print money." He then asked two other colleagues, "Tell Ali Khan how much you are worth." And they both said about $50 million, which was a lot of money then and is still now. And all their money was in Lehman's stock, which is why I always say making money in the market has three components: spotting the anomaly or opportunity, capturing it, and then making away with your profits. I have digressed. The point is, we all live in the real time, our faces pressed against a high-frequency screen. But a 10-year sweep in perspective is not something we afford ourselves in this seriously fluid and real-time world. As we look back, we can appreciate that G7 central banks basically flooded the world with free liquidity. This liquidity wave suppressed bond yields, and markets worldwide surfed higher, from emerging to frontier markets to cryptocurrency markets. African Eurobonds over the past 6 years, sub-Saharan African governments have issued $81 billion in dollar bonds. The markets have been like a patient etherized upon a table for a whole decade. It's as if the world became a Lehman to rescue itself from Lehman. It's been a decade-long Riviera. Since the beginning of 2018, the US has been reducing its balance sheet, reducing the amount of dollars, and also increasing the interest rate on those dollars. The dollar, which had appeared like a toy gun, is suddenly metasized into an AK-47. The worry is what happens if it metasizes further. The dollar is seriously weaponized, the US economy is blowing hot. The risk is that US interest rates will go higher than the market is currently predicting. Punch-drunk markets need to sober up fast. Hyperbolic and populist responses are inversely correlated to the state of the real economy, note Nicolas Maduro's Venezuela and President Erdogan. Now let me turn to the Eurobond markets, where Africa issued $81 billion worth of bonds over the last 6 years. These markets trade continuously. Essentially, these markets are a continuous scorecard on the credit worthiness of the issuer. It's a relatively recent phenomenon in the case of Africa, and something many policymakers will not have considered adequately, given that balance sheets are also maxed out. There are no more quaaludes, and policymakers will no longer be able to pop them. In prescribed doses, quaaludes promotes relaxation, sleepiness, and sometimes a feeling of euphoria. It causes a drop in blood pressure and slows the pulse rate. These properties are the reason why it was initially thought to be a useful sedative and anxiolytic. It became a recreational drug due to its euphoric effect. I concluded by saying bubbles are bursting just about everywhere. To wit that we became a Lehman in order to save ourselves from Lehman, this is the world's post-Lehman legacy, is a debt burden of almost $250 trillion. Further, you think the Fed or the ECB are the biggest money printers since the financial crisis. Think again. This trophy is held by the SNB. And then Tracy Alloway very kindly produced us a scorecard. Congrats to the investors who, in the midst of a global financial crisis and seize up of interbank markets, correctly predicted that palladium would be the big winner.